Ladies and gentlemen, on behalf of Kaptify Consulting Investor Relations team, I welcome you all to the Q1FY27 post-earnings conference call of GEE Limited. Today on the call from the management, we have with us Mr. Umesh Agarwal, Joint Managing Director, Ms. Payal Agarwal, Chief Financial Officer. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risks and uncertainties. Also, this is a reminder that this call is being recorded. I would now request the management to detail us about the business performance highlights for the period ended June 2026, the growth perspective and the vision for the coming years, post which we will open the floor for Q&A. Over to the management team.
Thank you so much, Mohsen. Good afternoon, everyone, and warm welcome to everybody, all the investors who've taken out their time post-lunch to join us on this earnings call. I'll give a quick brief overview to, of course, a few of you who have joined, for the first time, who are, probably tracking the company. So GE Limited is one of the leading welding consumables manufacturing company. We manufacture welding consumables with presence not only in India, but across the globe. The company is more than 6 decades old, with plants strategically located in both West Bengal in the east and Maharashtra in the west. So that ways we have a pan-India presence, supplying to all the critical areas. We have a very strong R&D team which actually caters and develops tailor-makes products for the key engineering sectors which really build the infrastructure in any economy. We work very closely with all the leading B2B companies like BHEL, L&T, JCB, Adani, ONGC. So all the sectors actually, primarily, I'll just give quickly that any and every sector that uses metal, be it steel, be it any other metal, has to use welding consumable, and that is exactly where we play our part. So yes, all these are, of course, we've been trusted by all the industry leaders. We work closely with all of them. And the first name that is featuring over there on the top left icon that is there of NPCIL, I would just like to give a brief update about that. This is a fairly recent development that has taken. And your company has secured a very, very strategic approval from Nuclear Power Corporation of India Limited. Now, as you all would know, that India is, as across the globe, this objective is to move towards cleaner energy sources, and energy as such is also a very, very, very hot, sector, because there's a lot of work happening in that sector. Now, nuclear power, of course, India today has a capacity of around 8.8 gigawatts of nuclear power capacity, which is expected to triple by 2031-32, but eventually go up to 100 gigawatts by 2047. And to even achieve these numbers, the government of India has not only outlaid around 14 lakh crores, for this capex, but has also opened this sector to the private players like Adani, Reliance, Jindal, So a lot of private players are also going to be working in this. In this context, securing this approval at this stage, at such an early stage, is, not only corroborates the company's technical strength and expertise, but also, gives a very strong barrier to entry, because this is a highly regulated nuclear sector. So this is going to unlock a huge market growth for the company, because there's almost, as I mentioned, a 14 lakh crore outlay in this. So that's a very big transformative sector that is going to play a huge role. And securing this strategic approval, of course, is a big milestone for the company in its growth journey. So that was one of the, of course, key developments that took place in this quarter. I think what Mohsen is showing on the presentation is some of the key sectors, and these are just some of the key 5 to 6 sectors where we are very deeply entrenched, where we are working very, very closely with all the leading players of the sector. So infrastructure, of course, the entire infrastructure, strength, be it the bridges, the roads, the industrial corridors that are being built by the government, they all require welding consumables, and we are empaneled with L&T, Tata Projects, Afcons, NCC, KEC International, BHEL, Thermax. Even with railways, of course, as you would all agree that there is a lot of capex lined up in railways, not only for building metro railway lines, for building freight corridor, for building station redevelopments, also for refixing the old electrical railway electrification projects and the rolling stock modernization. So we are, of course, working with RDSO. We are empaneled with Indian Railways for more than 10 years. Defense, of course, there was also a recent very significant milestone for the company, where the company was very closely associated with the commissioning of the 3 naval warships, which the Prime Minister of India also announced. And G is proud to say that we were supplying the welding consumables for those naval warships. So yes, these are the few sectors: the INS Dunagiri, yes, INS Agre, and INS Sanshodak. And it was a proud moment for us to be a part of this defense ramp up journey that the country is taken. So rather than being import dependent, now India is actually going ahead to not only being self sufficient in this sector, but also exporting. For the first time in its history since independence, it has started exporting to countries also in the defense sector. So that again is a proud moment for us to participate in. I'll give, of course, having spoken about the business, I'll give a key, brief overview of the key financial highlights in this quarter. The turnover, of course, went up by 30% year on year from 79 crores to 103 crores Q1 FY27. EBITDA again went up by around 77% from 4 crores, 4.5 crores to 8 crores. And the EBITDA margin going up by 204 basis points from 5.7 to 7.8%. Again, the PBT went up drastically from 1 crores to 5.5 crores, 318% of year-on-year growth. And the PBT margin again going up by 365 bips from 1.6% to 5.3% of turnover. The adjusted PAT again going up by 223% year on year from 1 crore to 3.2 crores, and the adjusted PAT margin going up from 1.2% to 3.1%, a growth of 183 bips. So that was the Q1 in a snapshot. The growth strategy, I'll just quickly recap and say that, of course, the company looks at growing to 1,000 crores by 2029-30, and that growth is going to be very organic, coming from its existing product basket. Of course, adding a few product verticals, which we have done in this quarter and will be doing in the Q2 as well. Target margins are to stabilize and take the EBITDA margins to a sustainable double digit, grow it from a 10% to 11 to and going up to 13%, and keep it sustainably, consistent at those levels. The holistic vision of the company and your management, the management of the company, is to really, evolve the company into a comprehensive welding solutions provider. So not only welding consumables, not only welding equipments, safety accessories, welding gear. It has to be a complete one-shop solution that we are looking at, and not only the domestic, but we are looking at a global footprint is what is the vision that is there for the company. And outlook is, of course, as we mentioned, that we are very, very, closely empaneled, and we are empaneled with almost, I would say, all the leading players across sectors, be it defense, be it infrastructure execution, oil and gas, power, energy, defense. Apart from that, we also have a very, very strong retail presence in the eastern and central of India. So that is another feather in the cap, where we want to leverage both these channels of distribution and take the growth forward. So yes, this is a brief overview on how we look at improving the margin, and how this roadmap of going from a 8 to 9% and slowly going up to 12 to 13%. So of course, as the turnover and as the volumes will increase, there will be an economies of scale, and there will be reduction in material cost as well. Improved sourcing strategies, of course, helps, and there is always going to be a better optimization level when there are higher levels of procurement. And improved formulations. So formulations, of course, in this industry are the key recipe to success. So the R&D team always works extensively on optimizing the cost levels. And apart from that, of course, there's very, very strict and kind of a conservative take on maintaining and reducing the operating cost. All these three and multifold actions is going to take forward and bring about a better margin in the future. Apart from this, a very big activity which is going to event which is going to happen for the company, in which we've already work is already underway for it, is a monetization of the Thane land. So there is a huge parcel of land that belongs to the company in Wagli Industrial Estate in Thane. The company already in the last financial year has signed a JD with a known developer, with a key developer in Thane itself, who's going to build commercial, real estate on that plot of land. By this action, the company intends to unlock the value of that parcel of land and monetize it. So the cash flows coming from it, approximately 400 crores over the next 5 years, is where the company looks at, going ahead and doing some inorganic growth and taking the company's growth journey forward from 1,000 to another 2,000. So yes, this slide of the presentation shows that what are the verticals that we are looking forward to expand in the organic via the organic methodology. Is the stainless steel wires, which the company already has production capacity. Also expand that vertical. Saw wires and saw flux, we've already started with commercial production in this quarter. Flux core wire is another vertical which is there. So again, all these are different technologies, different methodology to do welding. Ultimately, they're all welding consumables, just done through different methods. So flux core wire is one of the newer, relatively newer compared to stick electrodes. So flux core wire technology is also another vertical that we have added, and we have already, set up capacity for that. We'll be starting with commercial production in Q2, and going ahead for specialty products. Already we are doing on a smaller scale, like nickel and exotic alloys or maintenance wire welding, and also add to the product basket overall. So this is going to be the organic expansion route, and that's how we are expanding up to 1,000 crores. Apart from that, what I mentioned earlier in the previous slide, that the cash flows coming from real estate of Thane, and deploying of those cash flows, that is where we are looking at inorganic growth opportunities in the welding space itself. So welding equipments and systems is going to be a key product category that we have already enlisted, and we have already earmarked for acquisitions. We're also looking at specialty and hard facing electrodes that are high margin consumables, and that will improve the overall product mix of the company. And going ahead with complementary consumables like cutting, engaging electrodes and gas cutting accessories, the safety equipments. So these are few of the inorganic growth opportunities that are already there on the radar, and we are looking at optimally, incorporating that in the product basket as well. So yes, I think the industry tailwinds that actually support, and I will not only say support, but corroborate our theory going forward, corroborate the growth that we are envisioning for the company, primarily comes from the fact that there is a tremendous infrastructure boom that is impending in India. So the per capita steel consumption today also of India lies far below even the Eastern Asian economies which have developed, like China. I'm not even comparing with the Western economies. So that itself is a very important, significant marker of where exactly our numbers are going to go, where exactly the infrastructure boom is coming, and wherever there is steel consumed, a welding consumable will have to be consumed to just join those two pieces of steel. And that exactly, so the infrastructure growth, of course, with the government's imperative on infrastructure growth, with 1.4 trillion national infra pipeline, metros, power, railways, that it's going to, as I mentioned in the previous slide also, on the key sectors, the growth in the steel, the oil and gas, defense and energy. These are going to be very, very important sectors, which will see a huge transformation in the next 4 to 5 years. If I even talk about railways, there are already thousands of Vande Bharat trains, bullet trains, dedicated freight corridors, and station redevelopment that is happening already on ground that requires, welding consumables. So, and of course, these sectors and their transformational growth is definitely going to be the torchbearers for this industry. But also the industry itself today is at around 12 to 13,000 crores, and with a huge chunk of it in the unorganized sector, which more and more, with time, it is shifting towards the organized sectors with certified players supplying, because there's a huge reliance on, high integrity structures to be built. So that is why that is the role where certified, and where all these organized players are going to have a bigger role in the infrastructure development in the story of India. The technological shift, of course, going forward, stick electrodes still today commands a huge percentage of the industry, but going forward, new technologies are coming up. There is going to be later on more rise in robotic, also precision welding, and that demands for high performance welding consumables. The industrial automation, of course. So these are going to be key tailwinds that are going to that corroborate the story, and that corroborate what I'm talking about, the growth in the company. Because with all these sectors growing, it's imperative that welding consumable industry only grows. So yes, this means yeah.
Thank you, ma'am. We will now begin the question and answer session. All those who wish to ask a question, please use the option of raise hand, and we'll invite you to ask a question. You can also put your question in the Q&A box. We'll take the first question from Mr. Darshil Pandya. Please go ahead.
Hello, hi. Am I audible?
Yes, yes.
Yeah, hi. Thank you. Thank you, Payalji, for explaining us your business in a very detailed manner in such short notice. Madam, I have one question regarding to our recent, announcement on being empaneled in NPCIL. Just one thing is that who are the other partners who are also empaneled, and I understand it's a rigorous process to be in, but who are the other players in this, and what is the current, if we have any bid or something that will be doing it this year or the next year?
Yes. So currently, I would say in with NPCIL, I think it is DNH Session and DOR who are certified, and G. It's only these players who are certified by NPCIL. And hello,
We
Yeah,
have
yeah,
already,
great.
yes.
I would like to come in between. As far as we have already started the process, for example, like L&T, ISJEC, BHEL, NPCL themselves,
Hmm.
they have all visited our factory and inspected our factory, and already process has started. Even we are also expecting an inquiry from MEIL Hyderabad. So there are 7 or 8 good potential vendors. They are
Hmm.
in process to inspect our plant and start the work. We have already received orders also from 3, 4 major players.
Okay. Understood. And sir, since we are guiding for this 1,000 crore mark for FY 29-30, just to understand, see, like this demand has been in there since last 1, 2, or 3 years, and I understand that we are now entering into this capex phase, but our revenues in last 2, 3 years have been very stagnant in this behalf. So, what gives us this confidence for this year to grow at 30% mark?
The last 2, 3 years was the rough patch for the management, as it is
Yeah,
known,
correct.
and it is all known to everyone. So
Hmm.
now those we have overcome that, and that's why we are very confident, not overconfident, but confident. We will be able to achieve this figure what we are giving, and this is something we are not giving, which is I would say unimaginable or figure. These are very achievable
Absolutely.
figure, and it is going as per the market.
Correct.
And
And on
we have a capacity and we have a capability. Both we have.
hmm.
And in as far as in India, we have got one of the most strongest R&D team with us at present, and we are
Hmm.
very confident we would be able to achieve this figure.
So this EBITDA margins, are we planning to take it to 10, 11% this financial year?
See, that we are not 100%, but we of course we are trying, as we have already explained in our slide also. See,
Correct.
once this we increase our sales revenue, the economies of scale, and we are taking also further more steps so that we can reduce our cost. So
Understood.
hopefully, yes, we can go up to, but we are trying to get into 10% this year.
Understood. I'll fall back in the queue again. Thank you so much for answering my questions.
Thank you. We'll take the next question from Pramit Bomisetti. Please go ahead.
Hi, thank you for the opportunity. So first thing I wanted to understand in terms of the management mentioned that you'll increase our utilization of capacity. So I just want to understand because in your previous annual reports and presentations, you mentioned that your electrode capacity is far unused compared to your wire capacity. So does that mean you can interuse these capacities, or how does it work? Could you just give some guidance on that?
No, we cannot interuse these capacities. Both are independent. Electrode capacity is partly unutilized, so we are planning to maximize the sales of electrodes, which we have already done. That's why you will see there is a jump in sales. Our MIG wire capacity is almost exhausted. We are planning for further expansion this year itself. Both
Got it.
product lines are
So
different.
understood. So the distribution and clients are different for both of them, or how is it different?
No, see these are different process of building. So what happened? The same customer also use the different process to do the welding. Even they use MIG
Correct.
wire, electrodes, and even the flux core wire also. Might not be true for all customers, but those who are large customers, it's holds true for them.
Understood. And is exports an opportunity for electrodes, or is it too early to see, or is it
No,
not
no, no,
feasible to
no,
export?
no. Actually, this year you will see we are actually targeting export market, and we are getting a good feedback. This year we have already received orders from various countries, from Vietnam, Saudi, and Russia also. Russia also already our distributor is trying to get the NUX approval. If that is successful, then it will be great achievement for the company. And even Middle East, you can say Bahrain, Muscat, and Dubai as well. So I think this year we will be getting a good sales figure in exports.
So understood. So in terms of competition, so who are we exactly competing with when we're exporting outside to all these Middle Eastern and other Vietnam and Southeast Asian countries? who are we competing with? Is it China or someone else?
Oh, it's both China and even there are a few Indian manufacturers as well. And this year, for even for electrodes and for wires, stainless steel wires, you've seen one of the slide, which we are
Hmm,
planning to expand our capacity. And we are also taking approval from German Rail via TUV. And as far as the trade agreement, I think our product is also included. So from next year onwards, there will be a 0% duty on that. So I think we will be getting a good footwork in Europe market as well.
understood.
And
So
stainless
right,
steel is the only product where
hmm.
India is actually competitive than China
But why are we more competitive than China in stainless steel?
because
Because
of
of
the
raw
raw
material.
material pricing. Yes.
Got it. And our raw material pricing is based off having our own ores, or like why is it better, more competitive?
See, I would say because of the O's and all those facilities which India has it, we do not manufacture wire rods. It's all being made by steel mills and stainless steel. They are far more competitive. It's because of their own ores and everything available over here.
Understood. Got it. So, and so you mentioned that you also want to increase capacities. So, what kind of outlay do we have right now? And what kind of asset turn do we usually get in terms of in MIG wires versus electrodes when we're expanding
I didn't get you.
capacities?
I didn't get you your last question.
So, sir, we mentioned that you want to expand capacities, right? I want to understand the asset turn. So, for every crore of investment we might put, is it in terms of the revenue you'll generate, is it different from electrodes and wires? And if it's different, what is the difference?
See, Payal, will you take that?
Yes. So I think you're trying to ask about the utilization of the asset and the revenue generating capacity. Please, is that correct?
No, I was asking about the incremental capacity, not the existing capacity. Incremental capacity, what you have in mind. So, how much do we
Yes.
want to spend, and what are the potential revenue we might be able to
Okay.
generate from that?
So the incremental capacity that the company intends to spend upon is primarily, of course, ramping up the continuous wire rods facility, the saw wire and saw flux, which already the expansion has been done, and the flux core wire, which again the company is expanding in as a vertical. So these are the three. Apart from, of course, setting up ancillary machinery to facilitate higher production levels. And today, if we are at around 400 crores, going up to around 500, 550 this year, we are looking at around another 30 to 40 crores capex and going up to 1,000 crores over the next 3 to 4 years.
Understood. So, we are mostly focusing on increasing capacities on wires. And do you want, is there a future where we'll increase electrode capacity also, or we'll see how it goes? Because where do you see the opportunity going forward?
That is going to be a little distant future. I would say the next 3 to 4 years, we're not looking at expanding electrode capacity because primarily that is the place where there is a unutilized capacity that we have. So, of course, taking up that production by only installing ancillary machines like packaging lines or some other drawing facility lines, but not looking at expanding that up to 2029-30. Of course, after that, once the capacity actually reaches around 90 to 95% of utilization levels, then there will be an electrode capacity further expansion,
So, as far as the
but
company
not in
sees,
the immediate future.
so most of the opportunity still lies with wires, as far as the company sees it.
No, I won't say the most of the opportunity lies with wires. It's that the company's wire capacity is utilized up to the 100% right now. That is the
Got
case. That is why we're looking at expanding that. Electrode, fortunately, the company has ample unutilized capacity, and that is how we are being able to tap the growing market and serve that demand immediately.
Got it. And in terms of margins, how different are the electrodes versus wires?
So both electrodes and wires have a product mix, where there are where there are commodity products as well as, of course, high margin and niche product ranges as well. Even in electrode, it could be a silver brazing alloy, or it could be a nickel, alloy wire, or some other product like I would take, the JTIC series or whatever. So they, of course, demand higher margins, and of course, then there is a range of the commodity products products also which go in for general fabrication purposes on a regular basis, on a almost 24/7 churn basis. In wire and wire rods also there is a mix of both of these kind of products. So both of them have these kind of product baskets.
So is it,
Pranit, may I request you to rejoin the queue, please?
yeah, sure. Just
Yeah.
one last question. In the cash flow wise, I just wanted to understand, you mentioned the monetization, right? In the next year or two, do we expect any cash flows to come, or will it be at the end of
Yes.
second or third year?
No, we are expecting cash flows to start accruing.
Okay, and this will only be based on sales. It will not be based on the developer giving you a little bit before or nothing like that.
No, we are taking it as a purely, this thing, area sharing model. So, of course, the area that the company gets and dispose of or enter into agreements, that will be the revenue coming
Yeah,
from.
yeah. That's what it's up through sales.
Got it, understood. Thank you.
Thank you. We'll take the next question from Nishita Sanklesha. Please go ahead.
Hello, am I audible?
Yes, Nishita.
Yeah, so I just want a few clarification. So you mentioned that we need to incrementally spend 30 to 40 crores only to reach up to the revenue of 1,000 crore. Is that understanding correct? So like in the next 3-4 years, our capex will be 30 to 40 crores only, major capex.
So the major capex also 30 to 40 crores, of course, also comes from the fact that not only will be adding two new vertical product category lines like saw wire, saw fluxes, which we've already added on to, but also adding flux core wire. So I think a primary chunk of the capex comes from there, and then of course ancillary machines also, and shifting of the Thane plant to another location, and that is where we are looking at the capex.
Right. So what our current capacity from the presentation, I understood that it's
Yes.
59,000 metric tons, right?
Yes, yes,
And then we are increasing it up by 20,000 metric ton to 70,000 metric tons.
yes,
So that 20,000 metric ton is majorly going to be the wire capacity addition that you just spoke
yes,
about.
absolutely.
And for that, we'll need 30 to 40 crore of
No, no,
capex.
no. No, not.
No?
I think there might have been a disconnect in this. No, the 12,000 metric ton wire capacity is not going to require 30 to 40 crores at all. Actually, that's a very small quantum. That's going to be some quantum, but that's not going to be 30 to 40 crores. When I mentioned 30 to 40 crores, I was actually talking about shifting of the Thane facility to another location, setting up wire, increasing wire capacity, setting up saw wire, saw fluxes, vertical product lines, and flux core wire pull. All this together.
Okay, okay. So in this
Yeah.
30 to
So
40
does that?
crores,
Yes. So
in
does
this
that?
30 to 40 crores, the addition of 20,000 capacity capex also includes.
Yes, yes, yes. Absolutely. That is a
Okay,
small
okay.
part of it. Yes.
Right. So what will be the capex amount this year that will incur this year in FY27?
This year, I think we're looking at around 5 to 7 crores because, as I mentioned, or going up to 10, because, as I mentioned, we've already set up two product vertical lines, and we are also looking at expanding the MIG wire product line.
Okay, understood. And so from the 71,000 metric ton capacity, you mentioned that we expect to reach 91% utilization by FY29.
Yes.
So what is our peak revenue from the 100%? I'm assuming we can reach 100% utilization in the facility.
Yes.
So what will be the
100%
peak
utilization really
revenue?
doesn't happen because see what happens obviously in practically the placard capacity and the actually utilizable capacity always will be different because when you're changing different sizes and different dias and everything diameters of the wire, obviously the actual production capacity goes down. That is why I mentioned that once we reach up to 90 to 95%, and that is the time that we'll obviously, and before that only we'll start looking at now growing the electrode capacity also.
Okay, okay, understood. So what will be the peak revenue from this
So
complete 71,000 metric ton
from this
capacity?
itself, we are looking at around 850 around crores of revenue.
So, like, so then if it's 850 crores of peak revenue, then how do we expect to reach 1,000 crore by FY29?
Yes, yes. Fair enough. I understand. And probably I think you're getting a disconnect in the product vertical lines. As I mentioned, I'll just say again that we are also adding saw wire, saw fluxes, and flux core wire. That capacity we've not added right now because those are completely new verticals, product vertical range itself. So, because once we add those also into our product basket, we are expecting to go up to around 1,000 crores.
Okay, okay, understood. So what will be the capacity for those saw wire and flux core wires?
Umesh, can you just come in here? Okay. Okay. So I think right now, see, saw wire and saw fluxes and flux core wire, both we have set up one line. Going forward, as soon as the commercial production of each of these lines actually is a success, we'll look at expanding that. So probably it'll be too early on stage to say that what expect exactly capacity we'll set up,
No.
but that is what we are envisaging.
I would
Okay,
like to come
okay.
in over here. Right now, we have already set up a production line of flux core wire around 300 metric tons. Our plan, once it is properly set, our plan is to go up to 1,000 tons.
So this 1,000 metric ton will reach by FY29. Hello?
Hello?
Yeah, the 1,000 metric ton that we plan to reach up to are like, do we expect it to reach by FY29?
Yes, yes, absolutely.
Okay, understood. So 850 crores from the 71,000 metric ton capacity, and then the rest we expect to come from this 1,000 metric ton capacity.
Yes, this 1,000 metric ton itself will give you more than 150 CR turnover.
Okay, okay, understood. And the margins in this saw flux and flux core wires and saw wires are the same as our current products.
Yeah, actually, as Payal told you, the margins are similar. It depends upon the product lines. Each category has got a commodity and as well as special alloys. We will be manufacturing both mix of it. So depending upon the commodity, of course, it will be a little lesser margin. And the special produce like stainless steel, low alloy, nickel alloy will be giving you higher margin. So on an average, it will be more than 10.
Okay, understood. And my last question would be, so the current line that we have set up, when do we expect the commercialization to start?
Oh, the first line is already in process. I think by within by September end or early October, it should start the production.
Okay, okay.
Okay.
Understood. Yeah. Thank you. Thank you so
Thank
much.
you. Thank you. We'll take the next question from Tanisha Sonkia. Please go ahead.
Hi, can you hear me?
Yes, Tanisha.
Okay, so I just had one question. So looking at the quarterly trend, we can see that this year's revenue was slightly lower than last quarter. So, is there any seasonality in GEE's revenue, maybe due to the some monsoon related slowdown or construction? And do we expect this variability to become more pronounced in the future, or will it smooth out?
So in this case, see, the industry itself, of course, a very pertinent question, Tanisha, but the industry itself is slightly seasonal in nature because, of course, the first quarter and the second quarter, because of the onset of monsoons, the construction work is slightly stalled or delayed, I would say. So there is a bit of seasonality. So that is why, of course, in Q4, I think we would all agree on this call here that Q4 is always irrespective of seasonality of nature of industry or not, Q4 is always higher for all industries, be it FMCG, be it FMEG or industrial products. So of course, this industry, of course, does depend, and monsoons does affect the work, the nature of work that is there, monsoons affects it.
Right.
But comparing it with Q4, it won't be really a very fair apple to apple comparison. And to your the last latter part of your question, whether it will be more pronounced, I don't think it will become more pronounced or less pronounced. Really, it is just about a bit of the work getting delayed or spilling onto the next quarter.
Okay, understood. Thank you.
Yes.
Thank you. We'll take the next question from Nishant Bhatt. Please go ahead.
Yeah, am I audible?
Yes, Nishant.
Yeah, first of all, I want to congratulate the management for a good set of numbers. I
Thank you.
think the intent is really visible right now. I think business we already had a lot of potential, inbuilt potential, but the intent was not visible. Now it's very good to see that intent in the promoters. Majority of my questions have been answered, but I wanted to ask regarding the product mix right now. You mentioned that like we are into both commodity and specialized products. So can you just give me a mix of, how much is the percentage of specialized products in the basket as of now, and how much revenue usually comes from the commodity side of the business?
So currently around 27 to 30% would come from the niche product category, and of course the larger chunk coming from the commodity products. Again, in the commodity products also, it's not like that those commodity products only go to dealers or distributors. They also go to B2B clients also, who use these commodity products for general regular fabrication purposes also.
And I would like to further add on. Now, after this NPCIL approval and all this infrastructure development which is going on in India, are this niche product or special products percentage is gonna increase for sure. Like day before yesterday only we got an order, very prestigious order from BHL Trichy for P91 steel, where electrode goes for 30,000 hours of tensile testing or creep testing, which means for 3.5 years. So such special orders will also add to the basket, and we are very definite that percentage is gonna little increase.
Got it, got it. And you also mentioned that the management is more focused on the R&D side of the business also,
Yes.
which is a very positive advantage. I think already we can see some of the products have got a really good use cases. Regarding this, do we have any new products in the pipeline in the future which will be coming?
So as we said, ki flux core wire is coming, submerged wire and flux is coming, and even in electrodes also we are in very close discussion with various organizations. They want to do import substitute. That's the mandate by the Indian government. So that is one, and special the new steels which is coming up both for defense submarines. So they are also discussion in with us to develop consumers for that.
Got it. And my last question will be, you mentioned that, 1,000 crores is your North Star figure as of now. So majority of the capex which we'll be doing, it will be all brownfield capex, I'm assuming, right?
No, this will be primarily greenfield actually,
Okay.
because the up to 1,000, which is the current North Star for the company, is coming only from organic growth. So later on, from the journey from 1,000 to 2,000 is primarily coming from brownfield, where we are looking at inorganic growth opportunities and acquiring few of the tier two players.
Got it. Got it. That's it. Thank you for my.
Yes.
Thank you.
Thank you. Sir, we'll take one question from the Q&A box. What is the company's debt reduction plan, and by when do you expect leverage to come down to a comfortable level? This question is from Soham Kulul.
So the company's debt reduction plan, and you will be, pleased to know that already from Y on Y numbers, the debt, the interest costs have actually come down from last year from around 2.2 to 1.8. So from 2.4% to 1.8%. So that is the debt reduction that has already taken place by optimally utilizing the assets of the company and by optimally utilizing the cash flows of the company. Apart from that, just a reduction. So there is no existing term loan on the company's books. There's only a working capital limits that the company utilizes, which also we have a fairly comfortable headroom space with the banks.
Thank you, ma'am. Another question is from Jay Maru. He is asking, what is the status of Thane plant shifting? When will it be vacated and handed over to the developer?
Oh, we are already in process. I think by end of September, it will be completed.
Okay, sir. And one question is from Garvita Jain regarding that capacity. The specific question is that, is this capacity expansion included within the broader 71,000 metric tons per annum? And she's talking about the flux core wire expansion.
No, so the flux core wire and the saw wire line is not included. That capacity is not included in the 71,000 metric tons. I hope that makes this. I hope that makes this confusion. Brings clarity to this confusion. As Umeshi pointed out, the saw wire line and the flux core wire capacities are separate. Has not been included in the current numbers that have been given.
Okay. We'll take the next question from Harshad T. Please go ahead.
Hello, am I audible?
Yes, Harshad.
Yes, hi. So my question is, what is the incremental working capital required to achieve the 1,000 crore target that we have? I mean, what's your estimates for it?
So currently, the working capital limits are around 100 crores. The company, as I mentioned, has comfortable headroom space in that area. So we are not looking at incremental working capital limits in the next 1 year. Also, the cash flows coming from the real estate project are going to be also put to internal accruals apart from brownfield expansion opportunities. So right now, we're not looking at a major incremental working capital facility from banking institutions.
So you don't envisage taking debt or any dilution or anything like that?
No, we are not looking at taking further debt, considering the fact that there's a huge cash flow accrual also coming into the company.
Okay, understood. Thanks. Second question is, what percentage of your revenues are currently from shipbuilding, building and nuclear currently, and then how much would it be when you say achieve your 1,000 crore target about 3-4 years down the line?
See, at present, from nuclear, as we said recently, we just got the nuclear approval. So there's no such percentage for nuclear. But then coming in the coming years, it should be having I think a good chunk number. At least I would say we should be doing at least 10% of our business from nuclear. This is what we envisage. And from shipbuilding, now shipbuilding business will also gonna take up, for which the major consumption will come from flux core wires. So once that should also will take care of around 3 to 5% of our revenue.
Okay, and when we say shipbuilding, it is mainly naval shipbuilding, right? Or is it also including the commercial?
No, what I told you is about commercial shipbuilding.
Okay. Okay.
Defense, it's very difficult to say at the moment because there's all on order basis of the government and very difficult to project. But what is good for us that we are one of the major vendors. So if any such opportunity will be coming, we'll be getting a larger share of business.
Okay, got that. Yeah, thanks. That's all.
Thank you. We'll take the next question from Parimal Mithani. Please go ahead.
And thanks for answering the question. So I just have one thing. Your percentage of shares are pledged. What is it regarding, sir? And can you tell me what the timeline for the entire thing?
So the pledge has been done for a personal regarding the settlements of personal loan that the promoters had to take, and the timeline for the same are another 3 to 4 years, and we'll be slowly repaying and freeing the share pledge.
And what is the personal loan amount? If you can just clarify that, ma'am.
Sorry,
The personal loan amount that you're taking.
it's 40 crores.
Okay, and it's towards the business, or what is towards the entire thing?
Yeah, it is towards the business, towards the promoter settlement that actually took place.
Okay, ma'am. Thanks for the clarification. Thank you.
Yes.
Thank you. We'll take the follow-up question from Praneeth Bomisetti. Please go ahead.
Hi, thank you for the follow-up. So I just wanted to understand in terms of, you mentioned that you want to grow aggressively, but you had to also displace probably some of the players in the market. So how was the management exactly doing that in terms of business or price reductions? Could you just explain? Because growing at the rate you want is not really the industry growth, and it's far beyond it. Could you explain the strategy on how management wants to achieve that?
I'm sorry, I could you just repeat your question because your voice, the connection, your voice was lost in between.
Hello, I'm audible now.
Yes,
Yes.
yes, you're audible now, Praneeth. Would you please repeat your question as I lost your voice in between?
Yeah, yeah. So basically, just asking, when you want to grow at 20 to 30% growth rate, industry is not growing that fast. So you have to displace some people. Just trying to understand how is the company exactly doing that? Is it unorganized, organized, or price correctness? I just want to understand what is the company employing right now to grow at that rate, and how feasible is it in terms of margins or for us to do it?
So, when I say that, growing at a 20% CAGR vis-a-vis a 6 to 7% CAGR, which the industry is witnessing today. So, primarily, you have to understand that today, if you are at, occupying only 6% of the market share, if I say even if going up to 1,000 crores, which is the current North Star, we're only going to acquire a 10%, 12% of the market share, which really there is so much work today, and as I shared, the shift from the unorganized sector to the organized sector is only going to increase the organized sector's market. And with the fact that we have the major technical approvals, backing us, and a very key, flagship brand which places us deeply in the retail segment. So these two things, are going to ensure that, the growth from a holding a 6 to 7% market share to a 10 to 12% market share will not be very, very disruptive.
But you just talk about market share. I understand that if you see in a broad picture, getting from 6 to 12 might be easy. I'm just trying to
Yes.
understand because the existing demand is continuing, being satisfied by someone, and a competent player that continue to be happening. Just trying to understand, is it easy to do that to begin with? What is exactly different between,
So,
let's say,
I think, Praneeth, when you say competent players are already doing that, actually, you have to keep in mind the shift that is happening from the unorganized to the organized. So, when that shift is happening, really, there are no competent players. There is this market which is opening up. So that is one market which opens up. The flux code market wire market line also, the saw wire saw fluxes line also. As I mentioned, that these are relatively newer technologies compared to stick electrodes. So as these markets also open up, and with the amount of infrastructure work that is happening, so it's about gauging and capturing that market. So with the increase in the infrastructure work, if there are only 2 to 3 players or 1 or 2 key players who are going to be certified, of course, the early entrants are going to back the growth and going to ride on that growth. So we are looking at, capturing all these three tailwinds: the unorganized to organized shift, the key approvals, and being certified players and early entrants into this. Like, for example, as I mentioned, nuclear power capacity expansion from 8 gigawatts to around 22 gigawatts by 2000, tripling the this thing. So the early entrants are only 2 or 3, 1 or 2. So that helps the growth to come in double digit numbers also,
Thank
vis-a-vis
you.
the industry's growth.
Thank you,
I
ma'am.
hope, yeah.
Yeah. Thank you, ma'am. We'll take the follow-up question from Nishita Sanklesha. Please go ahead.
Yeah, am I audible?
Yes, Nishita.
Yeah, sorry if the question seems repetitive. So just wanted to understand the 71,000 metric ton does not include the saw wire facility, right?
Yes.
Yes.
But the 1,000 crore revenue target that we have, that is inclusive of both the 71,000 metric ton capacity and the saw wire capacity.
Yes.
Okay, understood. And my next question is that you mentioned our niche product contributes around 27 to 30% to the top line. So just wanted to understand how much incremental margin does the niche product category enjoy than the compared to the commodity products?
Oh, it's there are very different spectrum of products in the niche. So each enjoys their own. It's very difficult to give you a specific number on it. But what we
Okay,
will do
okay.
next time, we will try and take average of it and we'll make a chart of it.
Yes, that would be really helpful. Thank you so much. And all
Thank
the
you.
best.
Thank you. We'll take the next question from Nishant Bhatt. Please go ahead.
Uh, yeah. So just to last one question from my side. So you mentioned that you're looking for M&A opportunities, right? So while evaluating these M&A opportunities, is the primary objective to add manufacturing capacity and market share in high volume building consumables? Or are you more focused on acquiring, specialized product capabilities, proprietary technologies, or, application know-how that can basically improve your product mix and margins?
So rather, I would say you have answered yourself. This is the last part which you have said. We are more interested towards acquiring the different product verticals, or or second is the different technologies.
Got it. Got it.
Ha.
Thank you. Thank you. That's all from my side.
Thank you. Since there are no further questions, Umesh sir and Payal ma'am, would you like to give any closing comments?
Yes, I think thank you everyone, as I said, for your time today. And thank you for the trust and support. Of course, we look forward to leveraging our capacities, our strengths, core strengths, and expertise, and taking forward the company in a high growth, aggressive manner with sustainable margins.
Yes, Umesh sir.
No, actually, thank you everyone for the trust and the support, as Payal said. And we are very definite, whatever we are claiming, we would be able to achieve that. And with all your trust and confidence, we are pretty confident. Thank you.
Thank you to the management team and thank you to all the participants for joining on this call. This brings us to the end of this conference call. Thank you.